Why would a company report one of its best quarters ever and then watch its stock fall? That's because when it comes to the markets, good news isn't always good enough. During earnings season, most headlines focus on the numbers, results versus expectations. But it's not always that simple. Professional investors are often more interested in direction and future opportunities. Welcome back to Pointe Perspective, where each week we break down the markets, the economy, and the financial decisions that shape your future. If you don't have time to watch every episode, don't worry. We also publish a weekly newsletter that highlights the biggest takeaways. You can subscribe using the link below. I'm Christiana Lovelace. I'm a licensed financial advisor, an accredited asset management specialist, and the founder of Diamond Point Financial. Today, we'll explain what professional investors are actually focusing on during an earnings call and why markets can react so differently than expected. We'll also discuss why economists describe economic systems as existing on a spectrum of government involvement and what that means in the real world. And finally, we'll wrap up our monthly series on credit by discussing how strong financial habits are the foundation for excellent credit. The last thing people need is more fear around finance. That's why our goal with Pointe Perspective is to replace anxiety with understanding and headlines with context. Every few months, Wall Street seems to lose its mind. One company reports record profits and its stock falls. Another misses expectations and it rallies. Billions of dollars can be gained or lost in a matter of hours. Welcome to earnings season. Contrary to what many people believe, those moves usually aren't about what happened last quarter. They're about what investors think happens next. Once those reports are released, the earnings call comes next. If the financial statements are the company's report card, the earnings call is the parent-teacher conference that follows. Company executives explain the quarter, discuss major developments, provide guidance for the future, and answer questions from Wall Street analysts. In many cases, that Q&A becomes the most important part of the call. Anyone can listen to these calls. Most companies post the information on their investor relations website, and recordings and transcripts are usually available after. Let's break down 3 of the major earnings calls that happened last week so you can better understand these concepts. First, Alphabet. Alphabet had an incredible quarter, so why did the stock go down? Alphabet, which is Google's parent company, exceeded both revenue and earnings expectations. Google search remained strong, YouTube advertising continued growing, and Google Cloud benefited from increasing demand for artificial intelligence. Investors were not concerned about the revenue. They were focused on CapEx, which is short for capital expenditures. That's the money a company invests in long-term assets like data centers, equipment, and technology. Alphabet announced it expects to significantly increase its spending on AI infrastructure. And while those investments could fuel future growth, they may also reduce profits in the short term. So investors weren't questioning today's business or success, they were evaluating tomorrow's return on today's investments. Next, Tesla. Tesla stock dropped sharply after earnings. Much of the discussion centered around autonomous driving, robo-taxis, artificial intelligence, and Tesla's long-term strategy. The company reported weaker earnings per share, negative free cash flow, and a more cautious timeline for several future initiatives. Free cash flow is simply the cash a company has left after paying its operating expenses and investing in the business. Companies use it to grow the business, reduce debt, or return money to shareholders through dividends. Seeing all of this, investors became less confident about Tesla's near-term outlook and adjusted their expectations accordingly. Please keep in mind, one disappointing quarter doesn't automatically make a company a bad long-term investment. Sometimes it means investors believe their money may be better deployed elsewhere for now. If a company is part of your long-term investment strategy, that strategy should already account for periods like this. Lastly, Intel. Intel finally gave investors something they've been waiting years to see, and that's measurable progress. So why were investors still cautious? Intel reported stronger than expected revenue and earnings while highlighting continued improvement in its manufacturing business and growing demand for AI-related products. At the same time, management announced it expects to continue investing heavily in its long-term turnaround strategy. A turnaround investment is exactly what it sounds like. It's a company working to improve its business after a period of underperformance. Those opportunities can create significant upside, but they also require patience because meaningful improvements could take years, not quarters. That's why many investors chose to wait for additional evidence before becoming too optimistic. During earnings season, it's easy to focus on whether a company beat or missed expectations because those are the headlines we usually see. Professional investors tend to go one step further. They ask why those results happened and what management expects to happen next. More often than not, it's those expectations, not just the earnings, that move the market. What happens when governments, not consumers and not businesses, begin making more of the economic decisions? Who decides what gets produced, what it costs, and where resources are invested? The answer to those questions is one of the biggest differences between capitalism, socialism, and communism. Last week, we discussed free markets, where consumers and businesses largely determine prices through supply and demand. But no modern economy exists at either extreme. Instead, countries fall somewhere along a spectrum of government involvement. Capitalism relies primarily on private ownership and market competition. Socialism generally involves a larger role for government in owning industries or directing economic activity. And communism, in its traditional form, places the government in control of the means of production through central planning. Of course, the real-world application is usually more complicated than the textbook definitions. For instance, China is governed by the Chinese Communist Party, but its economy today is not purely communist. Beginning in the late 1970s, China introduced market-oriented reforms that expanded private ownership, entrepreneurship, foreign investment, and competition. Many economists credit these reforms as a major driver of China's extraordinary economic growth over the last few decades. Even so, the government continues to play a significant role in banking, major industries, and long-term economic planning. That's why it's often described as a socialist market economy rather than a purely communist one. Another economic misconception that's worth clearing up: countries like Denmark and Norway are often described as socialists. In reality, they operate as some of the freest market economies in the world while also providing extensive government-funded social programs. Those are two very different ideas. A country can have a robust social programs while still relying on private ownership, competition, and market forces to drive its economy. Other countries have chosen much greater government involvement. Cuba has historically operated much closer to a centrally planned socialist economy where the government owns or controls much of the country's productive resources. Venezuela also expanded state ownership, price controls, and government intervention across much of its economy. Supporters argue that these approaches can pursue broader social goals, but critics argue that they reduce competition, discourage investment, and make economies less efficient over time. Like every economic system, there are trade-offs. The question isn't whether governments participate in the economy, because they all do. The real question is how they participate and to what extent. One example here in the United States is the Federal Reserve. This week, the Federal Reserve is holding one of its regularly scheduled policy meetings, with Chairman Kevin Warsh speaking on Wednesday. Next week, we'll break down what was announced, how the markets responded, and revisit how the Federal Reserve fits within our economic system. What's the fastest way to get an 800 credit score? It isn't making more money, it isn't paying interest, and it definitely isn't going into debt. It's understanding how the credit system works and then using it to your advantage. If you've never had a credit card or taken out a loan, you don't have bad credit, you just have no credit. So where do you start? The first step is opening a credit account and using it responsibly. For many people, that's a basic credit card. But keep in mind, the goal isn't to borrow money, it's to establish a history of making your payments on time. From there, consistency becomes much more important than speed. Make your payments on time and keep your balances low. As we discussed last week, those are two of the largest factors that influence your credit score. Then avoid opening several accounts all at once and give your credit history time to grow. Now, if you're a parent, this doesn't just apply to you. It can shape the financial future of your children as well. If you have teenagers or young adults at home, one of the greatest gifts you can give them is teaching them how credit works before they need it. We opened checking accounts for our boys while they were still teenagers so they could learn how banking worked. correct. Once they turned 18, they applied for their own credit cards through the same bank where they already had an established relationship. Now, that doesn't guarantee approval, but it gave them a great place to start. Our boys tracked their credit scores and made their payments through the bank's mobile app while we reviewed the monthly statements, and we would coach them when needed. Some parents choose to add their children as authorized users on their own credit cards. That is certainly an option, it just isn't the approach we took. I believe there's tremendous value in allowing kids to build their own financial habits and confidence from the very beginning. It's also important to create a family culture where conversations around money are normal. In our house, conversations about saving and credit are as normal as asking how someone's day went. If you're rebuilding your credit, the encouraging news is that the process is essentially the same. Make your payments on time, reduce outstanding balances, and demonstrate responsible credit use consistently over time. If you can't qualify for a traditional credit card, a secured card may be a good place to start. You provide a refundable security deposit, and over time with responsible usage, many issuers allow you to transition to a traditional card. And please remember that this will take time. There aren't any quick fixes or any shortcuts, but there is a proven process if you commit to it. Whether you're building credit for the first time or rebuilding it again, remember that it's good financial habits that create strong credit scores, not the other way around. We live in a world that rewards quick reactions, but building financial success doesn't operate like that. Headlines are designed to capture your attention and evoke emotion, especially during times of geopolitical conflict and market volatility. Becoming educated on these topics through Pointe Perspective can give you the tools you need to make more thoughtful decisions for your financial future. If you'd like to learn more about Diamond Point Financial, you can visit our website or schedule a conversation with our team using the link below. I hope this offered some useful perspective, and until next week, take care.